Hey everyone, in this video I wanted to highlight one green flag for Disney stock investors, and that green flag is the direct-to-consumer, the streaming segment, and the improvements in profitability. So let's jump right into it. So I've highlighted here direct-to-consumer operating profitability in the most recent quarter ending July 1st. Disney's operating losses improved to 512 million. That was an improvement from a loss of 1.061 billion in the same quarter the prior year. Of course, you've heard of Disney CEO's Bob Iger's announcement and plans to cut more than 5.5 billion in costs out of the company overall, and one of the segments that's seen a benefit of that cost cutting is the streaming segment. If you look more broadly at the 9 months ending July 1st, the operating income has improved more moderately to 2.2 billion of losses compared to 2.5 billion of losses in the 9 months the prior year. So the latest quarter's improvement of 50% was much better than the overall improvement in the 9 months. Therefore, if Disney continues these improvements for the rest of this year, well, one more quarter left, you can see it making progress towards its goal of becoming profitable in this segment by the fourth quarter of fiscal year 2024. And you could see that would be a big improvement for the company's overall profitability because the streaming segment so far in 2023 has lost 2.2 billion, but the company's overall operating income was 2.2 billion. So it could nearly double its operating income just by breaking even in the direct to consumer segment if it can achieve that in 2024 overall, not just for one quarter. So one of the ways they're doing that, the CEO mentioned in their most recent conference call, is they're rationalizing the volume of content we make, what we spend, and what markets we invest in. They're not just trying to penetrate every single market in the world. And he moves on to say, we see a future where consumers can access even more of the company's streaming content all in one place, resulting in higher user engagement, lower churn, and greater opportunities for advertisers. And advertisers is a key here because only recently did Disney introduce an ad-supported tier for Disney Plus, and that's primarily been in the US and North America. It's going to offer that ad-supported tier more broadly as the quarters move on, and management has said that choice has been popular with consumers because consumers can pay a lower monthly price if they're willing to look at a few advertisements here and there. Since its inception of the ad-supported tier, 40% of new Disney Plus subscribers are choosing the ad-supported option. So almost half are choosing the ad-supported option. Also, increasing prices. This year alone, the company's increased its price in nearly 50 countries. And the impact on churn and retention has outperformed their expectations. As you're all aware, when you raise prices on a product like a streaming subscription, there's a likelihood that more people will cancel. Well, what management is saying is the number of people that have canceled as a result of the price increase is a lot lower than they were expecting. So again, that's a good sign and a green flag to be sure for Disney stock investors. Overall, the streaming segment and its improvement in transitioning the company to this next generation of content consumption is the primary green flag for Disney stock investors in the long term. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.